For this chart illustration, we're looking at the 4-hour time frame for USD CAD, and working backwards from the right, I can make note of a couple of things. First of all, there was a falling resistance trend line. This is a DeMark style trend line because we've got two clear connection points that are rejection wick highs. They're both swing point highs as well. So price comes down to a low, makes a swing point low, breaks this resistance trend line here, and in the days that followed, you could see a progression of higher highs and higher lows, denoted by the red arrows and green arrows respectively. There's another one here that's important because towards the right-hand side of the chart, we had what looked like a double top with a horizontal resistance trend line like so. Then on a strong, punchy up close, this bar right here, price goes through that double top, invalidates it, suggests that market flow is still bullish. So as we drill down lower from there, in around this time frame, it should have been possible to find a low-level entry trigger long. So what we're going to do now is apply trendline analysis to tell us that the trend is still up. Notice how we're doing that completely in the absence of any MACDs, stochastics, RSIs, moving averages, what have you. We're going to do that with trendline analysis. So I begin with the two most recent swings and I connect them like so. Now this is a case where price action is gapping in relation to a trend line. In other words, it's rising way above this trend line so that you would have to come down quite a ways just to break it. So I don't know if this one's going to do it for us, but we'll start from there and we'll update our analysis as we go. Let's do it bar by bar. Is there another trend line possibility here? Now there is, because I'm seeing this low and now this low. Let me clean this chart up a little bit so we have less clutter to deal with. There we go. So I'm now going to connect the green arrow towards the right-hand side to the first one back from there. And that gives me a fairly sharp trend line. But what it should do is tell me that if price breaks down and through it, I definitely don't want to be adding to my long position, and I may wish to consider getting out of my pre-existing long position. And I'll just add an extension there. So on this bar on the far right-hand side, we actually do have a close down and through. It's not a very sharp close, but it is one that suggests a trendline break. Price goes a bit higher, in fact, but then pulls back fairly sharply. So what we have to do now is determine whether that trendline break indicates a high-level trend reversal or merely a retracement. And I won't get into the mechanics of it just at this point, but the best way to do that is through top-down analysis. All we know is that when price has broken a trend line, that's not a good time to go long if it's a rising support trend line and a downside break, vice versa in the case of a downtrend. In any event, we're out of the long position at this point in time. Initially, price went a little bit higher up, but then closed sharply down, and that was a good place to be out. We're out of the long trade right here, and that's good because price came substantially lower down from there. So just wanted to show you how you can monitor an open long position with a rising support trend line, and when price breaks it in the opposite direction, that trend line is no longer intact, which means either a trend reversal outright or at least a retracement of some kind. You may wish to simply endure the retracement, expecting price to come back later, but you don't have to. A trendline break against an open position represents a logical place to book profit.